So back in 2014, I remember walking to Bard Market and heading to the first Bitcoin ATM machine in Ottawa. I was heading towards a pub and remember walking through this dark, kind of dingy hallway and about to put in my card and punch in my identity. And I was thinking to myself, am I really going to do this? Am I really going to buy one Bitcoin that was $423 back in 2014? And I just thought, what am I doing? I'm in the middle of a dark, dingy hallway in the middle of Byward Market, about to hand over my money to buy one Bitcoin. And I thought, I don't know what I'm doing. I have no idea how high Bitcoin could go to. All I could think about was, am I willing to lose $423? And at that time, it was a big fat no. So I decided to walk away. Well, of course, rest is history, because that probably costed me about $60,000. So in today's video, I want to talk about, quickly share my stories about my Bitcoin journey. By doing this is going to give you a bit of sense of what I do whenever I look at investments, what I look for, which is risk before reward. I always stress on risk before reward. I also want to share my risk and versus reward investment framework so that you can use it to look at your stock portfolio and look at it from use the same framework that I'm going to share so that you can decide what allocation of stocks to put in each pot. I also want to share a quick, easy peasy metric you can use to assess risk in a stock. And lastly, I want to help you figure out what is your risk tolerance, because I believe, including me, we probably overestimate our risk tolerance. So if you are actively investing in the stock market, or you're an aspiring stock investor, or you just love my channel, then be sure to check out today's video. Are you watching this channel and have not subscribed? Why not? I talk about stocks. I talk about real estate investing. I share my 20-year journey in as little as minutes in this video. And I share a ton of videos. So be sure to hit the subscribe button and that bell notification button so you get the latest and greatest videos coming to you. Plus, it's free. So let's get back with the video. All investments comes with risk. And at that time, when I was making my Bitcoin investment, walking up to that ATM machine, about to punch in my code and give all my information and spend $423 on one Bitcoin, at that time, mentally, I was not ready to lose 100% of my investment, because the risk in that investment was 100% risk, but of course, a lot of reward. But at that time, I wasn't as convinced. I had no idea what the reward ratio was. So at that time, I did not want to lose $423. So every investment comes with a risk. And some investments obviously have much lower risk, but then also could come with much lower returns. But that's not always true. And I really want to share my investment framework of risk before reward, just to share, how I assess risk. Now, how does this become practical to you? So a lot of investors actually equate volatility to risk, and so, for example, if you have a highly volatile, chaotic stock, people will think that's inherently risky. So how do you check the volatility in a stock? A quick metric that you can use is you can go to Yahoo Finance, check the beta rating, and you'll know that if a stock has a high beta rating, say over 1, well over 1, say like Shopify or Square, that means that whenever the stock market goes up, they will go more than what the average stock market will do. Or if the stock market goes down, because it has a higher beta rating of well over 1, then they will be amplified going down at the same time, versus a boring stock like TD Bank, which has a beta rating, I think much less than 1. That means that if the stock market went up or down, they don't go up as much as up, nor do they go down as down. They will have just a smaller percentage of what the rest of the stock market will do. So for you, you can quickly go to Yahoo Finance, check the beta rating, and anything equal to 1 means it trades like the stock market, like the rest of the stock market. Anything under 1 means it has lower volatility, and anything well over 1 means it has higher swings in the stock price. But for me, and for maybe a lot of you who've been in the stock market for a very, very long time, I actually don't think just because the stock has way higher swings that it means it's inherently more risky. It just means that maybe if you can't handle the volatility, the swings in the stock prices that swing up and down like 20% up, 20% down, then that beta rating can give you a good sense of what you are buying when you buy a stock, because that beta rating will tell you the swings in that stock price. So volatility, meaning the beta rating on Yahoo Finance, which you can easily find, or any other stock investing website, you look for beta. That's a great, I think it's a great shortcut to understand the volatility in a stock. Now, I'm about to share with you my investment framework by determining risk before reward. And I think by sharing it, and because a lot of times, the more risk you take, the more return you're expecting. But I also want to share that you can actually take low risk investments and have a high return. And so by sharing my investment framework, you can use this to help determine how many stocks you want to allocate to very risky stocks, because you also realize that you can lose 100% of your money, or you want to put a way more money into your low risk but low returns because they're like a savings account to you. So huge caveat, the way I invest in my stocks will be different from the way you invest in your stocks, because you probably may not agree, you probably won't agree, the reward ratio or the risk profile of the stocks that I look at, because you got to do your own due diligence and you will make up your own growth thesis and what you think is inherently risky about that stock. But anyway, I think it's great just to share it so that you get a sense of maybe what you can do with your stock portfolio. Now, my first bucket of stocks is the low risk, low return, okay? These are equivalent to my savings account, okay? They are super boring and they have very low beta rating. The beta is well less than 1, and you probably would have guessed it. What would fit in there? It is telecommunications companies, it is the bank stocks, it is the financial companies, it is the utility companies. So the stocks that fit in there from my stock portfolio are the TD Bank, Royal Bank, we've got Fortis, we've got TELUS. They all fit in the low risk, low return. I'm not expecting them to do high returns. I'm pretty much just expecting a dividend. They're dividend growth stocks. I'm just expecting my predictable, boring dividends come back to me every quarter. The next set of stocks that I invest in are medium risk but high return. Now, these stocks would trade in the market cap of at least in the billions, okay? They're not small cap stocks. They're in the billions, but still in the low billions. And the beta rating isn't super high, but they are high. There could be over 2, okay? So that's why I put the medium risk versus high return. So the stocks that fit in this category are Beyond Meat, Palantir, and Well Health, okay? I'm expecting, when I have these set of stocks, I'm expecting that, yes, I can absolutely lose 25% of those stocks. Those stocks can drop definitely 25%, 30% in the stock price. But at the same time, I could also see them amplifying 2x, 3x, 4x. The return is so much greater than what I'm willing to lose. So that's why I put those set of stocks into the medium risk but high return profile, because it's got much more higher returns. But at the same time, I'm expecting that I can definitely lose 25, 30% of my investment. Now, the next set of stocks are my low risk, high return. Now, these stocks are usually a huge market cap, in the billions. They also could be beaten up stocks, or they could be high conviction, regular companies that everyone knows about. So the stocks that fit in this category are Tesla, RioCan, Amazon, Google, Apple, okay? They are very low risk, but they have a huge return, like high returns. To me, anything like that can go down 20% is not a big deal because that's in the short term, but the returns are like well over 20%, 30%, 40%. Like they have a much higher return versus risk profile, but they're also in the big cap stock market cap. Okay, you look at the market cap of Yahoo Finance, you can see what the market cap of those companies are, and they're well-established companies. Now, my last bucket of stocks is in the high risk but high return category. And these are the stocks where, yes, I can absolutely lose 100% of my investment. And that's where I put Bitcoin in that category back in 2014, because at that time, I had no idea what Bitcoin was going to do. At that time, I was absolutely not wanting to lose 100% of my investment. So the stocks that fit in the high risk, high return category would be my Very Good Food, my Cloud MD, because I feel like, yes, I can lose absolutely 100% of my investment with those stocks. They're highly speculative, but at the same time, I'm expecting them to 2x, 3x, 4x, 5x compared to the initial investment I made. And as of today, they definitely have been well rewarded. So the risk was obviously absolutely worth taking for me. So what does that mean for you? And so I'm going to share like what I allocate to each of those buckets, so that maybe you can use this as a bit of a litmus test for gauging in your stocks, in your basket of stocks. So these speculative stocks, because they're very high risk, yet they also have very high return, I put no more than 10% of my entire net worth into those stocks. So if say you're 100% into stocks, then if you had $100,000 in stocks, you would put no more than 10% of $100,000, which is $10,000, into speculative stocks. So then at least if those stocks lost 100%, went down to $0, you would only lose $10,000 and you still have $90,000 worth of stock. So it's not really going to make any dent in your stock portfolio. Now, the next set of stocks I have is in the low risk, low return bucket, okay? Because I want for me, I'm a more cautious investor. So I'm much more long-term focused. So I want a huge proportion of my stocks in that category, just in case the stock market goes into a bear market or it doesn't really do anything for the next few years, meaning like it doesn't go up. The market kind of goes choppy sideways, so it's flatlining. That's what they call when it goes nowhere zone, or it's going through a correction or going through a crash. Then these stocks are really gonna just keep paying out its dividends. So I would allocate, for me, I've been allocating 50% of my stock portfolio into the low risk, low return stocks, which is equivalent to my savings account. Now, I understand that by putting this proportion of stocks into this big bucket, which is 50% of my portfolio, that I'm not expecting absolutely skyrocketing returns. In fact, they're safety, okay? I'm here to preserve my capital. So I just think they're going to be snail pace returns, and that's okay. Then the next, the rest of my stocks, which is like the rest of my portfolio, would be a mixture of low risk, high return, and medium risk, high return. And definitely in that bucket of stocks, they can fluctuate, up and down 20%, 30%, up and down, depending on the stock's beta rating. So in summary, just summarizing my investment framework, I'm going to give you what you can expect your stocks to behave like depending on the category that they're in. So with the low risk, low return, I'm pretty much not expecting much from my stocks except just predictable dividends and steady eddy returns. Maybe it goes up 5%, 6% every single year, or maybe sometimes it does nothing. And then after a few years, then it does something. So I'm not expecting a lot of returns, but then I'm also not expecting them to go down a lot with these stocks. Now, the next set of stocks are stocks that have high risk, high return. So with these types of stocks, I can expect losing 50 to 100% of my entire investment over the next 1 to 3 years. But at the same time, after that time frame, I'm also expecting that these stocks, if they execute well, to have much higher returns. They can definitely double, triple, or quadruple the return that I made in those set of stocks. But I put no more than 10% of my entire net worth into speculative plays. Now, when it comes to my medium risk, high return profile, I'm expecting that these stocks can definitely drop 25%, 20%, 15% over the upcoming year or two. But I'm expecting that in the short term, it's short-term pain, but they have long-term gains. So I'm expecting to double or at least double my investment with the medium risk, high return stocks. Now, when it comes to my low risk, high return stocks, I'm expecting that these stocks can definitely again fluctuate, 10, 15, 20% in the short term. Highly convinced that there's a huge probability that they are going to grow with these big cap stocks. So I put them in the low risk, high return profile and expecting that these stocks will go up 25%, 20%, 15% every single year in the long term. So are you like me where when I was younger, I completely overestimated my risk tolerance? I remember my financial advisor sending me a statement and it showed how my mutual funds had grown from $5,000 down to $2,600. So obviously it didn't grow. And that time I was freaking out because that was like my life savings. Like it went from $5,000 to $2,600. And I thought, hey, I have really high risk tolerance. But looking at that statement, I definitely did not have a high risk tolerance. So I think most investors, if you're especially new to the stock market or you've been investing just since like 2009, which is like the biggest bull market, you might have overestimated your risk tolerance. Because you know how you know is when the stock market drops like 30% or 25% and you start freaking out. Now here's two factors you can use and two questions you can ask yourself to really assess your risk tolerance. The first one is, what is your investment horizon? Is it like, do you have a long time frame where you don't need this money in your stocks for like 10 years, 15 years, 20 years? So what is your time frame for needing the money from your stocks? So essentially the longer the time frame you have, the more risk you can actually accept because over the long term, the stock market does well. It's just in the short term, there's always some blips and corrections and pullbacks. The second factor is, what's your risk appetite? Do you freak out if the stock market drops like 10%, 15%, like you see your stocks in the red? Do you freak out? That can determine your risk appetite. Now, here's the second tip. If your time frame is much shorter because you're actually planning to do something with your investments in 5 years because you want to retire, but then at the same time, you also have like rental properties and you have a very steady, secure job where you can rely on a big fat pension, then you're probably willing to accept moderate risks because you have something to fall back on, which is a secure set of assets like rental properties, or you have a pension, or you might have both, or you might have a very secure job, but you just have a shorter time frame. So I would say you probably could take on more moderate risks. Say you have a much longer time frame. You have 15, 20, 25 years before you touch any of your investments, but the pullbacks, like the stock's correcting itself by 20%, or the last crash really freaked you out, then it's probably a good litmus test to let you know that you're more of a cautious investor. Maybe you want to stick with dividend growth investing. You want to stick with stocks that have low risk but low return so that you can build up your risk tolerance over time. Anyways, I hope you found this video super, super helpful. If so, please give me a thumbs up. Smash that like button. And if you haven't subscribed, please make sure you subscribe and hit that bell notification button. Anyways, I hope you have a great day.